Welcome to the deep dive. Today we're really getting into Tesla's Q1 2025 update.
Right.
We've got the official report right here, the TSLA Q1 2025 update.pdf.
Yep.
And our mission basically is to look past just the headlines, figure out what's really going on with profitability, the production changes, and what the future might hold based on this.
Exactly. We want to pull out those key insights, separate the important stuff from the, let's say, the noise around the company right now.
Okay, so let's jump right in. Something that caught my eye immediately. Tesla changed over the production lines for the Model Y, their best-selling car, right? Across all four main factories, Fremont, Shanghai, Berlin, and Texas. All at the same time. Normally that's, well, unheard of for a top seller on a global scale.
It really is.
And they not only managed it, but they ramped up production afterwards, dealt with global supply chains, no major hiccups reported, and says a lot about how they operate, doesn't it?
It absolutely does. I mean, the sheer scale and the coordination needed for that. It's not like they phased it in. It was simultaneous. It shows, well, a certain confidence, maybe even sophistication in their manufacturing that's pretty striking.
Okay, let's dig into the financials then. Q1 2025 total revenue, $19.3 billion. That's actually down 9% from last year. What drove that dip?
Well, the report points to a couple of main things. First, fewer vehicle deliveries. And that ties back partly to those Model Y updates we were just talking about.
Right, the changeover downtime.
Exactly. Second, the average selling price, the ASP, it also went down even if you take out currency fluctuations. So that could be, the mix of cars they sold, maybe some incentives.
All right.
And then finally, there was a foreign exchange hit, FX, about $0.3 billion negative impact.
So some definite headwinds on the car sales side. Was anything else in the business sort of helping to offset that revenue drop?
Yeah, a bit. Their energy generation and storage business, that showed growth. And so did services and other. Plus, they actually got more revenue from regulatory credits this quarter.
Ah, the credits they sell.
Right. Those help pad the numbers sometimes.
Okay, moving to profit then. This looks like a bigger hit. GAAP operating income. That's down 66% year over year. Only $0.4 billion for a 2.1% operating margin. Ouch. What squeezed the profit so much?
Yeah, that's a steep drop. Several things were at play. The lower ASP we mentioned and fewer deliveries, those definitely hurt. Lower volume usually means less efficiency, higher costs per car.
Makes sense.
And their operating expenses went up. The report specifically calls out spending on AI, artificial intelligence, and other R&D projects.
Investing in the future, I guess, but it costs money now. Were there any bright spots balancing those pressures out?
There were some counterweights, yeah. The profit from the energy generation and storage side actually went up. That helped.
Yeah.
They also apparently had lower costs related to ramping up the Cybertruck this quarter compared to Q1 last year. And the cost per vehicle did go down a bit, partly thanks to cheaper raw materials.
But
Like we said, that benefit was kind of eaten up by lower fixed cost absorption because they were making fewer Model Ys temporarily. Oh, and the higher regulatory credits helped the bottom line too.
gotcha. Now, cash flow.
Yeah.
Operating cash flow was $2.2 billion, free cash flow $0.7 billion. But interestingly, their total cash and investments actually increased by $0.4 billion to $37 billion. So despite the profit drop, they still have a massive cash pile.
They really do. It suggests that, while this quarter's profitability wasn't great, the core business is still churning out a decent amount of cash. And that big reserve gives them a lot of flexibility, right, for funding future stuff and handling any bumps in the road.
Right. And just to round out the financials, total GAAP gross margin fell too to 16.3%, and adjusted EBITDA was down 17% year over year. So yeah, profitability metrics definitely took a tumble this quarter.
That's the clear story from the numbers, yeah. That big Model Y changeover, ambitious as it was operationally, it clearly had a noticeable short-term financial impact, both on volume and efficiency.
Okay, let's switch gears then. Operational highlights. You mentioned the new Model Y ramp is outpacing previous ramps. That sounds positive.
Absolutely. It suggests they're getting better and better at this scaling game, despite, the complexity of doing this everywhere at once, the speed they're getting the updated Model Y back up to, and even beyond previous rates.
Yeah.
That points to real improvements in their manufacturing know-how.
And the mega factory in Shanghai produced over 100 megapacks, those big energy storage units.
It is a solid number, and it really highlights how important that energy storage part of the business is becoming. What's also interesting is those 100 units didn't even count towards Q1 deployments.
Oh, why not?
They were apparently still on their way to the customer, so it hints at some pretty strong demand that's already booked.
Now, this really stood out to me. Model 3, Model Y, and Cybertrucks are driving themselves autonomously from the end of the line to the outbound lots in Fremont and Texas.
Yeah, that's quite something. It's a tangible example of them using their own autonomous tech in their operations. Dog fooding, basically.
Right. Probably saves time, maybe money.
Likely increases efficiency, yeah. And it gives them tons of real-world data for their AI systems right there in the factory environment.
Okay, back to the overall numbers, though. Production and deliveries were down year over year. Total production down 16%, deliveries down 13%. Model 3Y, pretty much the same.
And that's largely what you'd expect, given the Model Y transition, right? It's that temporary dip while they switch things over. The fact that deliveries of their other models, the S and X presumably, were also down, that might be worth keeping an eye on going forward.
Good point. The report also lays out their installed annual vehicle capacity, factory by factory. But we should remember that's capacity, not necessarily current output.
Exactly. That's the theoretical maximum, if everything runs perfectly all year. Actual production depends on parts, maintenance, upgrades, all sorts of things. It's like the top speed on your car speedometer. You can go that fast, but you usually don't.
They also included a chart showing market share over the last year. U.S., Canada, Europe, China. Be interesting to see how that develops with more competition popping up.
For sure. EV market share is incredibly dynamic right now. These numbers give us a baseline, but yeah, watching how they hold up against everyone else in those key markets will be crucial.
Okay, core technology. Let's talk FSD, full self-driving. They show the graph of cumulative miles driven with FSD supervised. Big news. They launched it in China, first market outside North America. And apparently the feedback's positive, even though they didn't use country-specific training data. That feels significant.
It's very significant. It suggests their core approach, using vision and a global network, might be more adaptable across different driving cultures and road systems than some thought. Getting positive initial feedback in China, which is a unique driving environment, that's a strong signal for the tech.
And AI is repeatedly mentioned as a huge growth area. Not just for cars, but for autonomous robots, stabilizing energy grids. It feels like AI is really becoming central to everything they're doing.
It seems that way, yes. They're positioning AI as this foundational layer that connects and enhances everything: cars, robots, energy. It's becoming their core narrative almost.
And they keep pushing out software updates. Adaptive headlights, a rear cross-traffic chime, small things, but they add up, and a new tutorial app for China.
Right, and that just highlights the benefit of having that software-defined vehicle, doesn't it? They can keep adding features, tweaking things, tailoring to local markets, all remotely. Keeps the cars feeling fresh.
Battery tech. They launched an IRA-compliant 4680 cell. Those bigger cells, IRA-compliant
means cars using them, like the Cybertruck, qualify for that big $7,500 U.S. tax credit.
Okay. That's important. And they're working on diversifying the 4680 supply chain, building lithium refining and cathode plants in the U.S., aiming for 2025 production. Sounds like bringing things closer to home.
Very strategic. It reduces reliance on potentially shaky global supply lines, taps into U.S. manufacturing incentives, and gives them potentially more control over the whole battery stack, which is, vital for EVs long term.
Okay. Energy and services. Energy storage deployments still growing year over year on a trailing 12-month basis. Powerwall deployments hit another record, crossed 1 gigawatt-hour deployed in a quarter for the first time. But they mentioned their supply constraint.
That's key. The demand for home storage, Powerwalls, seems really strong. The fact that they can't make enough suggests the growth could be even faster if they could ramp up production. Huge market there.
And that Shanghai megafactory we mentioned, besides the 100 units made, its current annual capacity is 20 gigawatt-hours, potentially doubling to 40 eventually. That's a monster factory just for grid storage.
It is. And they highlighted its localized supply chain, which is a smart move given all the global trade uncertainty right now. That factory is going to be absolutely critical for meeting grid-scale storage demand worldwide.
Services and other also saw profit growth, 25% year over year, mainly from better non-warranty maintenance and collision services. And the supercharger network keeps growing, over 1,800 new stalls added.
Yeah, so the service side and the charging network are becoming more meaningful contributors financially. And the growth in charging sessions and energy delivered shows just how much that network is getting used. It's a real asset.
All right, finally, let's look at the outlook for the rest of 2025. On volume, they sound cautious, noting uncertainty in car and energy markets because of trade policies. Growth rate depends on autonomy progress, production ramps, the general economy, and they'll revisit guidance in Q2. Sounds like they're hedging their bets a bit.
I think that's fair. It's a prudent stance. Trade policy shifts, economic slowdowns, those things can really impact a global business like theirs. Revisiting guidance next quarter makes sense in this climate.
And for profit, they expect hardware profits, from selling cars and batteries, to be joined more and more by profits from AI, software, and fleet services over time.
Yeah.
That reinforces that more than a car company idea.
Exactly. It underlines the strategy. Build the hardware base, then layer on higher margin software and AI-driven services. That's the long-term financial narrative they're pushing.
Now, the new, more affordable models, still on track for production, start in the first half of 2025. But interestingly, they plan to use aspects of both next-gen and current platforms and build them on existing lines.
Right.
This means maybe less cost reduction than originally hoped, but it's a more capital-efficient way to grow volume quickly. It's a trade-off, it seems.
It does seem like a strategic pivot, maybe. Prioritizing getting volume up faster, using the factory they already have, even if it means the cost per car doesn't drop quite as dramatically initially. It lets them target that roughly 3 million vehicle capacity faster without massive spending on totally new lines right now.
And the purpose-built Robotaxi, the Cybercab, with that unboxed manufacturing idea, still slated for volume production starting in 2026. So that's still definitely in the plan.
Yep, the Robotaxi vision is still central. And that unboxed manufacturing concept, well, it hints at potentially radical changes in how vehicles could be assembled in the future, especially autonomous ones.
And they wrap up by saying they have enough cash, strong balance sheet, committed to maintaining that financial stability message.
Yeah, basically reassuring everyone they have the resources to fund all these ambitious plans and weather any storms.
Okay, so to wrap up our deep dive on Tesla's Q1 2025, it was definitely a challenging quarter. Financially, revenue, profit down, mainly due to that big Model Y changeover and market jitters.
Definitely felt those impacts.
But operationally, they hit some major milestones. That impressive Model Y ramp, the autonomous cars in the factories, the energy side keeps growing strong, and the future plans for cheaper cars and the Robotaxi are still moving forward.
That sums it up well, I think. Short-term financial pain from the transition, but continued progress on the core strategic fronts: autonomy, energy, and scaling production.
So here's a final thought for everyone listening. With Tesla putting such a heavy emphasis on AI across cars and energy, how might their unique blend of manufacturing skill and software development give them a long-term edge, even with market ups and downs and trade issues? And what could that unboxed manufacturing strategy really mean for how cars are built down the road? Some interesting things to chew on there. Thanks for joining us for this deep dive.